You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry. We've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune means it's time for the funkiest show here on the old Options Insider Radio Network. It's time, yes, for TWIFO This Week in Futures Options, the program where, as the name implies, you break down the week that was and indeed still is on the futures options side of the fence. So we'll talk some commodities, talk some ags, talk some metals, some indices, mix it all in together, and you got yourself some TWIFO. My name is Mark Longo from theoptionsinsider.com. As well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If you're new to TWIFO, first off, welcome. Secondly, you got a lot of great episodes to catch up on. The easiest place to do all of that. In fact, if you just subscribe to TWIFO, head on over and upgrade yourself to the full network feed. You get up to 15 shows there, daily news, volatility views, option block twice a week, all that fun stuff. You get it all there. Subscribing to the network feed so you don't miss a beat. And of course, for all of you hardcores out there, we got a little bonus for you. You can join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern via Mixlr, MIXLR. So grab that link if you follow us on social media. Set it in your bookmarks. Follow us on Mixlr if you like, and then you'll know exactly when we go live. You won't miss a minute of the show. And of course, however you listen live after the fact, make sure you hit us up. Questions, comments, insights, all that fun stuff. We do, believe it or not, we do actually like to hear from you guys. And joining me on the program today, starting off, we got a couple of in-studio guests, which is always fun. Let's start off immediately to my left, my cohort, my futures options partner in crime, the founder of Bantix Technologies and the creator of a little platform we like to use once or twice around here called Quick Strike, Mr. Nick Howard. Nick, welcome back to the show, and indeed, welcome back to the studio.
Yeah, it's nice to be back, and it's good to have Sean next to us as well. I always like to give a little teaser of who's up next.
You are known for your teasers, sir. So let's get right to it. That laugh means we have another in-studio guest. He's been in studio before, but I think this is his first appearance actually on the show proper. He is Sean Smith, the Managing Director for Derivatives Licensing and Exchange Data over there at FTSE Russell. Sean, welcome to TWIFO.
Mark, thanks for having me. Nick, thank you for the Quick Strike plug. Sitting next to you, it's a pleasure to be here.
And Sean, as we are wont to do with all of our first-timers here on the network, why don't you go ahead, give us a little bit of an overview of your background in the derivatives space, and then how you found your way over there to FTSE Russell.
Sure, happy to. I've got, I hate to say it because it's dating myself, I've got about 30 years of experience. I started on the Philadelphia Stock Exchange back in the late 80s. Started there as a runner, quickly joined a company called O'Connor & Associates, an options trading firm that was acquired by Swiss Bank, and then Swiss Bank was merged or acquired by UBS. Moved to New York, traded on the American Stock Exchange, equity derivatives, options, and on the New York Stock Exchange, had an options floor, traded there. Moved to Chicago, traded S&P options on the CME, and then traded Eurodollars and Eurodollar options as a local, and then went to the brokerage side of the business for a few years, became an executive with the CME Group back in the early 2000s, spent some time at a startup futures exchange, and then went back to the CME, spent many years in the CME's clearinghouse, got some phenomenal risk management experience there, and then most recently joined the FTSE Russell Group, the parent company is London Stock Exchange Group, and now I manage the derivatives licenses for FTSE Russell, and it's.
I'm sorry, you truly have been a derivatives man about town. I often throw that out there, but in your case, it seems to apply. Did you two bump heads in the Eurodollars pit at all?
No, it just crossed paths.
We just crossed paths, yeah.
Well, no, you were in there when you were in the CME. That's when we crossed. I mean, we weren't ever in the pit together.
No, we were never in the pit together at the same time.
But we were at the.
We worked the same company.
Yeah, we did. Yeah. But we didn't even cross paths over there, did we?
No, that was actually equities. You were fixed income.
That was the other side of the building.
Yeah.
There was a big trading floor, and it was a very. It was as wide open as it was. I didn't cross over there too much.
No.
To the equity side.
No.
To the dark side.
I was afraid of the equities.
We're friendly guys.
Too many different strike symbols. It was scary for me.
Coming from Eurodollars, that's saying quite a bit, because Eurodollar is kind of the king of strikes and weird strikes and weird symbols. Well, that said, Sean, it has been an interesting time to talk a little bit Russell, because it's kind of been in the news a lot late. Of course, we talked about it a lot on the program. We had Ron Bundy on, I believe it was about a month ago. We've had Tim McCord on from CME talking all things Russell. Now it's indeed your turn. It's been an interesting time, of course, as we've documented here on the show. It's been a big migration underway of bringing FTSE Russell, I guess you might say, back home to CME Group. So you've obviously been knee-deep in this process. Sean, give us a bit of an update. How has it been going, and how has this whole process been unfolding?
Yes, thanks, Mark, and great question. The transition of the Russell 2000 back to CME has happened at an exciting pace. It's beyond our expectations at this point. Very, very much exceeded those. But we're very excited to see that the market has seamlessly, and it looks like without a hiccup, transitioned the majority of their business over to CME, where these products will thrive and continue to grow. We look forward to that.
You said beyond expectations, so it sounds like this is exceeding what you guys were looking for. I know it's politic to keep things low key, particularly when you're bringing, you're moving a product back and forth. It's always a challenging process, but it sounds like the market is indeed responding, and you're seeing perhaps a more aggressive response than you anticipated. Do you think that's just people were hungry to sink their teeth into Russell again? You think it's a platform thing? What do you think is driving this?
I think that the suite of equity products that the CME offers in complement to the Russell, that entire equity complex now is a place where the Russell products will thrive because of the credit efficiencies and the market efficiencies of having that suite of equity products to trade against, to clear against. The margin efficiencies, the credit efficiencies are a tremendous offering from the CME's perspective.
Yeah, so this too, because we're getting a lot of this feedback. In fact, we'll get to our listener poll in a little bit about this topic as well. But we're getting a lot of feedback from people out there. It could be general retail, it could be professionals, both of them saying, vol is kind of boring right now. S&P vol is kind of in the toilet, aka the VIX. Not a lot going on there. So a lot of people are reaching out to us looking for alternatives. And as we've said before, going all the way back to the launch of RVX, we were talking about that in our Volatility Views program. The Russell just inherently should be more attractive to vol traders because structurally small caps should be more volatile than the large caps. You think that's maybe playing a little bit of a part as well? People are not maybe seeing the setups or the structure that they want in, let's say, the S&P, so they're starting to look a little bit farther afield?
Did you want to answer that, Nick? Or?
I think anytime you get another part of, I don't know if another portion of the equity sector, right, where it's just the small cap, you're going to get a little bit more interest and the fact that we are on such low volatility, and the Russell should technically, because it's the smaller cap stuff, and have a little bit more fluidity in the earnings and just in what affects them from a business standpoint. So yeah, you would think that, and frankly, right now that vol is higher from just a general vol number than the S&Ps, and I didn't look at it against the NASDAQ, but yeah, I think it'll be interesting now that the roll is done, right? Now that all of the futures are over there, to see if the option activity starts to pick up a little bit. There was a big 30% increase this week in the option open interest, which is going from like 10,000 to 13,000. So
Right.
so now that the roll is done, people see that it went well. And I don't have to deal with it anymore, right? There's probably some stragglers out there, but probably not really. It's done. I mean,
The roll's done, yeah.
yeah, the roll's done. So I mean, I think we'll get a real measure of volatility when we start to see the options open interest start to really take place. And I think if it were me, I would have waited until we get everything over there as well. So I think now you're going to start to see some maybe some cross product stuff going on, but I would just imagine more open interest. In a 30% jump this week, because it's basically a week or 10 days post roll, probably a good sign.
And I think the role itself and the attention that it has brought the marketplace happening, the majority of the volume transitioning in this very first roll has brought a lot of attention to the product, which brings option traders to look at the options as well. So I think that momentum and the incredible marketing machine of the CME, they've been putting out some incredible educational information on the Russell and their products that I think they're getting a lot of new customers trading the product.
Yeah, Tim, Ron mentioned this on the show. Tim mentioned this on the show. Ron mentioned it as well. The roll being kind of a big demarcation point for you guys, really waiting to see what happened there. Walk our listeners through, who may not be as familiar with the product, why the roll was such a big deal and why perhaps it was such a success for you guys.
As this is going to be kind of really basic, so I apologize if I'm being too fundamental, but as an option expires, there's quarterly options, right, September, March, and June. When the hedge is in the front month contract, so when September expired, all of those open interest holders of those futures roll their hedge or their portfolio or their positions to the next quarterly month. And it's a very traditional move just prior to expiration of that futures contract. And there's a specific period of time where the roll trades the most. And that roll occurred from the position at our partner exchange, ICE, and transitioned over to CME. And it happened in quite a sweep. It was, as I said, exceeded expectations. But the interesting thing is the different ways that the CME had positioned various ways to do the roll, which I think made it very, very easy for customers to do that. They had the calendar spread itself. They had BTIC, and they have blocks. So each one of those three mechanisms made it very easy for not only retail and professional traders, but also buy-side clients, hedge funds, and banks to facilitate the roll of their position to the next quarter in a really easy way. I don't know, Nick, if you want to comment there?
I'd like to. You're exactly right. The marketing that they did for the roll was unbelievable. In fact, they had a video that talked about all three of the things that you just said, and the video was just, it was like I understood it, right? And I never.
If you didn't know anything about futures,
yeah, you still got it.
You
did
get right. It was that good.
That's what made it really easy. And then the roll's important anyway, right? Because it happens. It happens every quarter.
It happens every quarter.
And I'm sure you know there were some people that used to just come in and trade the roll and then never come to the floor again.
Oh, on the trading on the floor,
yeah.
There were full-time just roll guys that would show up 3 days a quarter.
Right, they made
trade the roll, and they made the money, and they got out. Yeah,
because they knew that it was edge across,
massive volume
across the spread. So it's important anyway, and then it's going from one exchange to the other, and they made it crystal clear. Like I really was surprised when I saw that. I was like, boy, I actually understand what's going on, and the fact that they did it and people let it expire, and then, like Sean mentioned, the cross margining, all that kind of stuff. It's good, and that's why I hedged a little bit in my comments prior to that. But really, I think now that you have everything in one venue, it's just going to make the product that much easier. And I think people will start to, especially when we start to talk about the skew, especially when they start really looking at the volatility levels and stuff like that.
You know, it's funny. You mentioned, obviously the roll is a big moment, just trying to attract that volume. But you also had it sounds like the added challenge of rolling between two platforms, which is, I think, a pretty infrequent occurrence. You don't see that very often out there. So, I mean, maybe walk us through really, really quickly any of the challenges you saw there. And it sounds like maybe it wasn't as challenging as you thought. 'Cause like you said, this process has exceeded your expectations.
Yeah, there weren't any challenges. The CME made it really easy from the individual to the institutional trader to roll their positions in a very seamless, without a hiccup way. And again, that marketing and education that they did prior and during this roll was, I've never seen anything like it in terms of making sure that customers knew their options there.
Yeah, it was good. And one last thing along that same line is they even had CME Direct has the ability to embed some marketing in the product and the tool itself, and they even had that information embedded during the roll period in there, so you could actually watch that and still be in your trading platform. It made it really. It was really good. I mean, and that part I found the most interesting is just how straightforward it was.
And Sean, any data points you want to share with us? Obviously, it's been as new days for the product, but maybe any interesting trends or volume highlights or open interest, anything you're seeing out there right now in the Russell product that's maybe catching your eye?
Well, the open interest in combination of futures and options is over 550,000 contracts. They're averaging about a little over 60,000 contracts a day in average daily volume. It's healthy. It's a tight bid ask. Oh, that's another interesting point. The spread market in the roll was a tick wide for the majority of the roll. It was an incredibly tight and liquid market, which is the real key to capturing that roll. So I'm sorry to jump around to statistics, but you just made me think of that when I was talking about volume and open interest.
That's impressive for that much paper going up that tight. That's
exactly, yeah.
It's a no-brainer at that point, right? I mean, you're not losing any money.
No,
right? And
it's as tight as it can get, right?
Yeah,
so
exactly.
Good tight markets.
For sure.
Well, it's been interesting to watch. Like we said, we talk a lot about the all things index, and when it comes to volatility in particular, that's always a thing that interests us here. And a lot of people have been hitting us up about other index choices. Like I said, we'll get to your votes in a little bit, but it's always fun to watch. Nick, you and I have talked before about how Russell being kind of an interesting beast from a volatility perspective, because not only is it structurally just, I think, should in general terms be a little richer than all things S&P, all other data points being the same, but also, the skews a little bit of a more interesting beast out there. We've talked S&P skew before. We have a whole other show on the network where we talk a lot about that. It varies by slope, some days a little bit steeper than others. But that's kind of all you're going to get out there in the big S&P skew. Whereas, Russell skew, a little bit of a different beast. I know you like looking at it over there in your all things quick skew. What's catching your eye out there this week in Russell skew land, Nick?
Yeah, I think when we first started watching it, that's one of the first things we talked about was how the Russell skew looked to the S&P. And I think initially, I think the first 2 or 3 weeks, we noticed that the Russell skew was a bit under in the regular S&P skew, meaning that it was a little flatter. And later on, I think once the market realized that it was over there, it kind of tilted back towards where the S&P was. But if you look this week, it's definitely much flatter than the S&P is or has been. And again, not knowing much about the market other than watching the numbers, right? I never traded the index or anything like that, but I think the name might say something. The fact that it's S&P 500 and the Russell 2000, you have a little bit more distribution. Therefore, you might have a little bit, more in the equation might mean less volatility from a overall movement standpoint. So that could be why it's a little bit flatter. It's flatter than the NASDAQ. It's flatter than the S&P. But again, I think because it's so early in the life cycle for this product on the CME along with the other index products, it's going to be more interesting to watch. Right now, there's about almost 14,000 OI in all of the expirations for the Russell. And I mentioned earlier that's like up 30% this week. So as that starts to increase and there's more of a footprint to kind of measure and there's more more strikes open, more settlements, and get a better representation of where the vol is, it will be interesting to watch how that skew tracks. And that's something that we're going to have to do a better job of being able to plot the skews on top of each other for the different products so we can start tracking the index and see. And what also we could do is we can start tracking the sectors of the S&P against the Russell, right? So we get a little bit more possible measurement, apples to apples type of thing. So it's a lot flatter. So if you're looking at it, the skew's a lot flatter. The vol's a little higher in the Russell from an overall level standpoint. Again, we don't have much measurement, and I think the market will sort of tell us where that's going to go. And we'll have to look at that intercommodity spread volatility level over some time to see if it looks rich or cheap or not. So that's
I can't wait to see that overlay. That's going to be interesting to look at.
Yeah, I think the spread and the overlay will be just so we could see how it changes. And the spread over time, I'd be really curious. I think we got enough data that we might be able to take a look at that and put something out.
Yeah, I think that skew overlay would be a huge one. It seems like every time you come on the show, Nick, I feel bad. We send you away with more projects and more work to do here. But that one, I think a lot of our audience would. Since we're talking about that, I'll bump this up now. I was going to do it later in the feedback section. We'll get to it now. We've got a poll out there for our audience. We asked you guys, hey, SPX volatility, aka VIX, kind of in the toilets, hovering in single digits right now. So where are you guys getting your index vol fix these days? Gave you 4 choices. Russell 2000 could be any flavor. Pick your poison. Could be the E-mains talking about now. Could be maybe the old school RUT IWM. Could be even RVX for all sorts of crazy flavors out there. You could be looking at the Dow. Could be looking at NASDAQ. Or are you perhaps going to maybe buy and hold VIX and wait for a rebound? Sean, as our guest, you get pride of play. I have a feeling I know how you're going to vote, but we'll see. First off, what do you what is your vote? Which index do you want people heading into for their vol trade of choice? And then B, perhaps more importantly, what do you think our audience is voting for?
Great question. Of course, I'm going to pick the Russell vol.
Surprise! I'm stunned. Sure, I'm flabbergasted.
It's an interesting product. It's not as it doesn't trade in high of volume as the others, but it's a great indication. And I think small cap stocks are definitely in a major focus right now. So it's definitely something to be watching. In terms of others, I think you're going to get a mixed blend across the suite of product.
Even breakdown, huh?
Yeah, I think so. Well, you've got margin offsets amongst the various products at CME Group. But that's why I think you'll see a little bit of a spread across.
Mr. Nick, same question to you, sir. What are you feeling? What do you think our audience is feeling?
Well, I'm gonna go with the show and talk about Russell, and I think the reason for that is because it's new, and it's a place that people should be experimenting a little bit and kind of taking a look at it and making some markets or paying attention to the markets a little bit more. I will say the one thing I'm really disappointed in just of what you have mentioned. First of all, VIX. I don't get the VIX, so I'm never gonna really just don't get it. It's the opposite of everything. It's the fear. I don't understand it. So, but what I'm really disappointed is I don't get why the Dow doesn't trade more, the options on the Dow, because it's one number.
That is a strange one for me too.
It's one number, and why not you just and everybody, and it's the Russell's not on TV all the time. S&P's on there, but most times people are quoting the Dow dropped this much or the Dow dropped. So you would think that the options is just a number. I just don't get that it doesn't trade more. But I'd like to see the Russell trade more, only because I think the NASDAQ doesn't trade as much as we think it trades from an option standpoint. So it would be, and I believe like the S&P, when you consider that one of the big cap stocks can move that thing more, and nothing else has to happen, and that thing moves up, you're not going to see that kind of thing in the Russell because there's so many of them. It's not going to affect it. So I think it's just you have the ability to try to measure the market more than you would in the S&P, because Apple can make the thing go up 60 points and everything else is in the toilet or stagnant. So I'd like to see the Russell, only because I like when new products breed new analytics, which breeds more interest in general in those markets. So I think that'll be where I would
That's a good point on the Dow. My first day ever on the floor of the CBOE, I walked on as a clerk the day they launched the Dow options. And it was huge fanfare and music. I think Baton they had all kinds of celebrities and sports stars. It was huge fanfare. I thought, this Dow option is going to be just the next big thing. And it kind of just withered and died from there. So, yeah, I always had a little bit of a soft spot for the Dow options. I've always wanted to see them kind of resonate, and not so much. Speaking of resonating, let's see what's resonating with you guys here so far. You got fortunate listeners. This is only for the live crowd. If you're listening after the fact, you're going to miss it. But this one so far, we've got let's see, 65% whopping saying they're not going to give up their VIX. They're going to buy and hold VIX and hope for a rebound. Maybe, I don't know. That's been a rough trade for almost all of 2017. So good luck to you if that's the way you're proceeding. About a quarter, 25%, getting into the old Russell. So you guys are sneaking in there now. Not bad here. I guess all the myriad appearances on TWIFO are starting to make an impact.
What percentage was that again? I'm sorry.
25% for the Russell. So there you go. And then 10% for the NASDAQ. I actually thought NASDAQ would do higher because NASDAQ's kind of been like the stealth vol generator the last few months. It had some surprises out there. We saw NASDAQ doing. And speaking of what we were saying before, 0% for Dow. Zero, nothing. Goose egg. No love for Dow. So I don't know what's going to take out there to resonate, make Dow resonate, but it's not today, not on this show at least. Before we move on, we got to hit crude a little bit as well here. Sean, any other data points, any other nuggets, any other little things you want to tease or leave us with about Russell before we get into a little bit of crude action here?
The volume and open interest kind of speaks for itself. I get excited every day when I look at these numbers. I'm just looking forward to future growth of the product now that the roll has occurred and the market has spoken. Now it's it's about growing the product. So,
yeah, I think along those same lines, from the option standpoint, we mentioned a number of times what the open interest, a 30% change this week, pretty evenly distributed between the puts and the calls, and more importantly, open interest in 8 of the contracts, right? So that's a positive as well. The end of months aren't trading so much yet, but that again, I'm not surprised given the fact that it's a newer product. People are going to dip their toes in the shorter dated stuff, even though an end of month will be short dated at some point. It's just kind of a different thought process. But if we had open interest in one contract or the front month only and stuff like that, I'd be really nervous and disappointed. But we've seen increased open interest over the last 6 weeks, and then the distribution across the expiration or the term structure. That's a really good sign.
Yeah, speaking of good signs, a lot of people out there are also looking for some good signs out there in the crude land in WTI this week. Didn't really get it so much. Net on the week, kind of crude, pretty much up slightly on the week, but not perhaps the sustained rally north of 50 handle that a lot of people were hoping for, certainly if you're a crude bull out there. Also saw vol kind of pretty much mixed as a result. Didn't really see vol move a lot, coming off a little bit in the front portions, kind of staying relatively firm out in the back portions. Kind of as you'd expect. Everyone's kind of playing wait and see for the next round of meetings coming up here. Before I get into what was lighting it up this week from a hot options perspective, let's get into, it was an interesting, the big headline this week, Nick, an interesting record out there in WTI land. weekend. We saw, WTI eclipsing Brent out there in open interest, the first time since 2014. So it's been some time. Brent had, for a number of different reasons, kind of shifted into primacy internationally, and now WTI taking back the reins. A lot of that on the strength of domestic production, shale cranking it up again. How much have we been talking here on the show, Nick, about domestic supply, all of that combining for 2.4 million contract open interest out here in WTI, which is, again, enough to bump it. Of course, oil hovering around $50 a barrel seems to help a little bit, too. The producers are a little bit happy out there, getting a little more contracts. They can actually hedge at these levels, whereas they probably didn't want to in the mid to low 30s. Interesting stuff to watch here. Some interesting graphs here, too. I think there's big write-ups out of FT and others kind of showing how the OI is kind of converged and then merged again. U.S. production up here projected to be north of 10 million barrels a day here by into the end of next year, Nick. So pretty interesting stuff. Did this resonate with you, Nick, as well? People starting to gravitate back towards WTI, or is this pretty much what you expected?
I probably can honestly say I didn't know what to expect. I mean, I kind of watch them in general, both as they go along and when interesting things start to happen. So I think now I'll turn my attention here a little bit more. But, we haven't really paid attention to the WTI versus the spread since the spread started to trade towards zero, right, when there was some fear of some incoming oil tax with the new administration. So this will be, I think, something that we can keep an eye on. And, again, this is probably another item that we can right now you can track it in Quick Strike by looking at the Commitment of Traders report, because we have both those products in there, so you can take a look at it from that standpoint. But I'm not sure what I think about it. It makes sense based on what the articles that are out there and what they're saying, and the fact that the shale producers can come back into the market and see that the product is stabilized around 50, because I think a long time ago when we were talking about it, they had a break even of like $38, right? So now there's just some profit in the market as well. So I'd say that I'm going to say I don't know what I expected, but I think we'll pay attention a little bit more, and it'd probably be interesting to see. I would be interested to see if the OI starts to shift where the WTI is, and then I'd like to see what the prices start to do again from a spread standpoint, because I really don't know how that relationship starts to tie together, the price and the OI, or if it's just based on the fact that there's producers out there and more available to do the shale production right now.
Yeah, I mean, obviously, with so much focus these days on domestic supply, it seemed kind of inevitable that WTI would kind of retake the throne. Obviously, if you're producing domestically, you're going to be hedging with WTI. It's kind of the contract of choice. So it seemed like it was on the road, and it finally broke it this week for all of you guys out there who watch such things. Speaking of things to watch, what were the hot options this week out here in crude land? Number one with the bullet, we've been talking before about kind of, it used to be that 45-50 strangle / risk reversal, call it what you will. Now it's moved up a bit because crude has moved up a bit. We're north of the 50 handle, so we're seeing the double calls getting on the upside of that range. That's where the action was this week. Nearly 16,000 of those lighting it up, including pretty much half, nearly 9,000 going up on Monday alone. And a good chunk of that, over half actually, is opening, almost half opening this week. So a lot of back and forth, but opening action on the double calls, which is kind of interesting. So maybe some near-term bulls come into play, or some overriders, and followed on its heels. Number two, not quite the 50 puts. Usually the 50 puts are where the action is. This week, a little bit lower, the 47 puts with nearly 14,000 again. The lion's share coming on Monday, about 7,000 and change. The rest of the week kind of light. By the way, I neglected to mention at the top of the show, you guys can follow along with your own reports, cmegroup.com/TWIFO, TWIFO. You can look at exactly what Nick and I and Sean are looking at right here, right now in real time. You can do that all week long, so it doesn't matter if you're tuning in live or if you're tuning in at midnight on Tuesday. It doesn't matter. You can still go check out those reports. Just if you're tuning in later, just adjust the expiration settings so that you can see exactly what we're seeing here around showtime. And then number three, also the 49 puts. So some interest in the puts out there, about 13,000. The lion's share coming today, actually, nearly 5,000 going up today. Also a good chunk of those coming in as opening. And also we like to look a little bit farther out here in good old crude as well. See what people are positioning in. You get to Jana next year. The 60 is also pretty active. Nearly 6,000 of the 60 calls lighting it up. So some people perhaps thinking we have a little bit more room to run on the upside. We also see a little bit farther out here as well. The DEES 2018, a little bit pretty much at the money now. The 51 calls also lighting it up about 4,000 times out here. And not to be undone, you go all the way out to DEES of 2019, and that's where someone has a lot of interest in the 100 strike calls. The DEES 2019 100 strike calls putting up 1,102. To be precise this week. So interesting stuff. Seems like a lot of that might have actually been closing this week. So perhaps someone deciding discretion, the better part of valor out there on that, shall we say, aggressive upside bid in all things WTI. Mr. Nick, I know you like to watch all things quick skew out there. What's been catching your eye out there from a skew and from a vol perspective this week out here in WTI?
Yeah, following up just on your OI comments first. There was a couple articles this week in the Journal about the range or the open interest in the front contract being the 45 and the 55, and kind of bounding the trade price for the crude. Those strikes are starting to tighten a little bit, where we're creeping up to the 48 and the 50, or the 48, probably the 48 more so, 45, and then up to the 48. So going forward, again, as always, it'll be interesting to see when we start to breach those different like big OI points or strike points with the actual underlying. Because first and foremost, I always start to use those as the technical analysis to see what our support and resistance is going to be. And I'm learning more and more just from some of our customers. We have a lot of foreign customers that trade, as an example, the FX, and they look at their support and resistance based on the big points of OI as well. So I got to imagine that that's happening as well in these other products. Even though this is a commodity fundamental, they're looking at it in the FX, but there's a fundamental, right, and then there's the technical where the trade's going to take place in the hedging. So I think we'll watch that. The 45 to 55, that's kind of a bogus range. You and I always talk about how $10 range on a $50 handle. It's not saying too much, but it really starts to, if it starts to tighten up again, which it seems like it will, because we haven't gotten much more than a 2% move here and there on this.
What was that report came out a couple of months ago that it was between 35 and 70 over the next 2 years
with some shocks.
Very outlandish, very risky prediction.
That was not a good prediction. But from a skew standpoint, this week it looks sort of in general like the calls got less cheap across the term structure, and the puts got a little bit less expensive, not entirely. So what does that mean? That means we got the curve that, like, you took the left side and you pulled it down, and you took the right side and you lifted it up. So we got a little bit of a tilt. That makes some sense as we start to stabilize in between this, around this 50 strike. It's always interesting to watch the way the curve looks, just to get an idea of, whether people are indifferent or whether people still think there's some downside risk or some upside potential. So right now, the market generally looks pretty boring from an underlying movement standpoint. And from a skew, it just sort of, as you start to get sort of this balanced range again, the curve will start to stabilize and be more like a teeter-totter, that with two people on it that weigh the same amount, then, one fat guy on one side and then a skinny guy on the other one, tilting it one way or another, So
I like how you're looking around the studio when you say that.
Yeah, well,
so keep that to yourself.
I don't have to look far for staring at you.
We're all good looking.
Yeah, we all have faces for radio. So, but that's probably the biggest thing about the quick skew, and then overall the volatility levels. Vols in this week a little bit. Vol's still low, but it's not as low as it's been. And, there was I forget the conversation exactly. I have to go back and look. But, it's not as – we had a really low vol when futures were really high. But that low vol with the high future gave about the same trading range as you get with this volatility at this price, So the range is generally, the range of movement and underlying with this volatility at this low price is about the same as the range was at the high price. So that's really, but anybody could see that by looking at the report right now and looking at the comparisons. And then after that, again, which is always good, this continued increase in open interest, another 5% again, almost 3 million contracts now, just in the ones we have covered here in Quick Strike. So all good from that standpoint.
Yeah, an active week. OPEC continues to deliver with their meetings and the anticipation and driving not so much vol, but definitely some OI out there. Speaking of which, you guys always like to hit us up, not just OI winners, but who won the week who lost the week from an overall performance. We make it very simple. We don't break it down in vol terms or OI or volume, anything like that. We just go straight up which product on the old CME platform won the week and which one lost the week. Winning this week, actually, out in the ags. We haven't talked ags in a while, Mr. Nick. I got the oats up nearly up 5.2% this week, followed by feeder cattle 4.6% and live cattle. Good week in the ags and in the livestock there, 4.2% out there. On the flip side, not such a good week in a lot of the metals, including silver down nearly 4% and iron ore down nearly 9% this week. Platinum off a comparatively light 3% this week. So the metals and lean hogs taking on the chin, 2.93% to the downside. So a lot of pain being felt in the metals front. You know what's not painful though is answering some of your questions. So let's get right to it with our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. Like the man said, this is the portion of the show where you guys take the reins. Questions, comments, insights, pearls of wisdom. We love them all. Hit us up. You guys know how to do so. Social media, the live chat, wherever floats your boat, email. So hit us up. You guys like to. Maybe someday we'll have a whole question and answer show, because you guys are always sending us all sorts of crazy queries. Like I mentioned at the top of the earlier in the show there, we have that big shakeout going on there on our question of the week here. With the old vol, it looks like the numbers are still the same, 65, 10%, 25%. You got about a few hours left if you want to vote in that poll. Here's a good one. Might be interesting for you, Sean, to weigh in as well. This comes from Andrade 8. He or perhaps she asking, hey, Russell and the Qs, if their vol is always higher than SPY, does that mean you're getting paid more to sell out of the money puts? Now, this is an interesting question, and this kind of alludes to what I was saying earlier on the show, Sean, about how there seems to be a certain contingent out there that is just attracted to products like Russell and others because structurally they're going to be a little bit more volatile than others. Maybe before we even get into the specifics of the question, is this something you're seeing a lot? Are you seeing people, because you deal mostly with institutional clientele, are they starting to maybe warm up to this concept, to this use case of Russell being a place where perhaps maybe when other indices are, shall we say, a little bit off from a vol perspective, Russell is still going to be a little bit higher? Is that something they're starting to come to you and maybe ask about and be aware of?
Actually, yes. The vol skew, I think Nick was kind of talking about it being flat as he was looking at it earlier today, or flatter than historically. But yeah, if the skew's higher than and in Russell as it has historically is, there's a trading opportunity there to write puts. But again, I'm not one to give you any kind of trading advice or strategies. But skew means that the volatility value is higher, and options decay like all options decay, and there's the opportunity to capture that additional skew as options come closer to expiration. So it's definitely, from a fundamental perspective, a trading opportunity.
Yeah, I mean, if you're out there harvesting premium, that's the technical term they all like to say. Harvesting premium. If you're looking to harvest premium, there is, on a percentage basis, maybe more of it out there to be harvested in the old Russell. So I think that will certainly, if you are out there, and I know a lot of you are, judging by your feedback and your response to all the myriad studies we see out there on the different ways to harvest premium by selling puts. I don't care if you're going to the risk management conference or whichever conference you're going to. It seems like everyone talks about that these days. Then certainly it might be an interesting thing for for you to peruse. Mr. Nick, anything you want to add here for our friend here, Andre 8?
I think what you want to probably try to do is if you get a chance, well, on the free version of Quick Strike Essentials, you can go out and take a look at the pricing sheets for both the S&P and the Russell, and then go to a similarly dated expiration and then hover over the tick price, and it'll show you what that looks like in dollars. So I just did a quick one on like a 28-day contract, and they're roughly, the vol's higher in Russell, but I think it has a smaller dollar amount, right, on the contract than it does. What's the multiplier on the Russell? I mean, $50. Yeah. So I mean, I think you got to go and take a look at it on an expiration to expiration basis, and then a contract size. You got to look at the contract size for sure, because based on the contract size versus the other tick amount and all that kind of stuff, then you'll be able to see where you're going to get the most bang. But the 25 deltas right now on the S&P 30-day looks like they're close to being same dollar amount.
Yeah, I guess it's kind of subjective what he means by getting paid more. If he means net dollar amounts, yeah, then no, because it's obviously a high percentage of a smaller number is still going to be smaller. But you're talking so net premium probably not, but even percentage wise, certainly. So obviously, like Nick said, you can do the math on Quick Strike. You can see exactly for yourself how much you're going to get paid to harvest, how much you're going to harvest out of that premium. So good question. Yeah, this is I think
a correction for you. The RUT is a 100 multiplier on the options, just so you know.
Okay, yeah. So that's going to be. You got to look at that, right? Because you got to look at contract size, and you got to look
notional
at
value.
Yeah, notional value.
Yeah.
So that answer is not going to be just given by the volatility.
Right.
So you got to really pay attention from that.
It would be nice if, vol 50, vol of 100, I'm making more selling the 100, but unfortunately there's a lot more that goes into that. But I think we'll be seeing more questions along this line as Russell starts to get more into the consciousness a bit. People start realizing, they, for whatever reason, they want a new flavor of premium to harvest. That might be the place where they're looking. Here's another interesting one, Mr. Nick, getting over into this gets into the crude land. BLM3. These handles are mouthfuls this week. He or she wants to know: is there a big arb between USO and WTI? Well, yeah, they're obviously very related products. Obviously, USO being the crude oil kind of effectively basket ETF, and then WTI being the West Texas Intermediate contract. One of the best ways, there's a lot of ways you can look at that, Nick. Obviously, the flow directly, but I think one of the easy ways to look at that is to look at something like the comparative volatilities of both of those products and how much they move in lockstep. You can do that really easily. You look at OVX, which is effectively the volatility for USO, and then OIV, which is effectively the volatility index for WTI. You can see how much those products those levels are almost the same, and how much they move in lockstep. If those products were not linked, Nick, then we would not see the vol pretty much do such a pirouette to them. But they are related. We don't talk a lot of USO on here because obviously our purview is the futures options. But I know for a lot of the retail out there, that's one of their go-to choices for crude. In many ways, an entry-level product for when they maybe want to step up to some of the bigger crude options out there. I don't know, Nick, anything you want to add here? Any thoughts aside from maybe the vol in terms of the ARB and what they could see between USO and WTI?
Yeah, I don't. That's a big question there because you're talking two different price levels, and then
I didn't tell you we're extending the show another hour today, so we can answer all these questions.
No, I mean I wouldn't even know. There's some. You'd know better than me because you actually watch the USO so much. I pay attention more to the futures price, but I think that you have the risk internal to the USO with the rolls, right, with the calendar rolls all the time, and then you have that price jumps a little bit more based on the rolls, right? So I think you have to look at the volatilities. I'm sure somebody's done that comparison. Somebody's trying to arb that, but I don't really have much color on that one.
Yeah, of course, obviously with all these products, they're trying to replicate. And underlying with these baskets of products and also baskets of futures, you have, like Nick mentioned, all sorts of roll and negative yield issues that bake into which we could go on for quite a while talking about. But effectively, there is an ARB, and it's interesting. I think probably the easiest way to get a sense for that is kind of just watching those volatility indexes on those products. Then you can start maybe branching out from there, looking at some of the flow and digging into the construction of USO a bit to see what actually goes into that and how they might want to ARB those with the big futures there at WTI. All right, moving on. Let's see. Here's an interesting one, Nick. This kind of speaks to your, and Sean's a bit too. He spent some time out there in Eurodollars land, so I don't know if so much on the rates, but he wants this M. Burrow to say, hey, no love for rates on TWIFO. We hit rates. It's just we can only pick so many products to go in a given week. That said, we were talking records out there in WTI breaking Brent. There were some open interest records over there in the rates complex this past month out there in CME groups. Maybe we'll hit on a couple of them. Overall, Treasury options, 7.2 million contracts open back on August 24th. The Treasury futures, nearly 10.7 million contracts set back on August 28th. The ultra 10-year, about 461,000 on August 28th. And the good old Fed funds, about nearly 2 million, 1.8 million contracts over there on September 1st. Also, single-day volume, in getting specific here, in the Wednesday weekly Treasury options set back on August 29th, 59,000 contracts, and in the ultra 10-year back on August 25th, it was 464,000 contracts. So a few records out there. You know, Nick, you're much more, I think, of a rates-leaning guy than I, because you spend so much time out there in the euro dollars. Anything you want to add here for our friend here? What was the M. Burrow, who is shaming us for not loving rates sufficiently, according to his tastes? He wants it to be the rates TWIFO.
Yeah, I mean, I always love rates, and if you've ever been in Quick Strike, very tilts towards rates in terms of if there's more reports, they're more oriented towards the rates. But there's a twofold problem with looking at the rates and watching the rates. First of all, Fed funds is, has good volume on the futures, but there's basically no options open interest. So as much as that becomes a key part of what's going on with the FOMC and the Fed governor meeting and stuff like that, there's nothing to discuss from open interest or from a volatility standpoint. Now, what's interesting there is you can start looking at the Fed Watch tool, which looks at the Fed funds, and it goes out several years, so you can start to see what the futures are stating in anticipation of where the rates would be. So that's something to discuss, and that's something we should probably do a better job of and probably cover it the week prior to the FOMC, or at least look at it. As far as the Eurodollars go, it's a weird trade for a lot of people that haven't traded it before. I mean, it's great. It's got high open interest records again, right? And it's a very institutionalized product. Even though it's easy to understand from a premium standpoint, it doesn't trade like the other stuff. You're not going to get that same sort of. It kind of moves and sits, and occasionally have. So from a retail person standpoint, it's going to be a buy and hold type of thing. So it's not that we're not interested in it. It's just that it's not something that has the same sort of like price action that you will for something else. And then when it comes to the treasuries, there's a huge amount of activity out there, as you can obviously see, and that ultra 10-year has been an ultra success from an open interest standpoint. And then you see all the trade that occurs. But what you have to start to pay attention, what you have to know, two things that bother me about the treasuries, just in even being oriented towards them. They trade in 30 seconds and 64, so the math's always a kind of a pain in the rear end, and even like doing what your deltas are and how you're going to scalp it with the underlying movement, you got to do 2 to 1. So if you do it all the time, it's not a big deal, but it's something you got to consider. But then also the strikes aren't really strikes towards anything that you recognize right off the bat. There's a price associated with the future, but it really becomes targeted towards a yield, and then you have to do that calculation in order to see where the yield is. Now, we offer a Treasury Analytics tool that's out there from an end-of-day and sort of intermittent intraday update that's out on the CME Group website, but those are all things you got to really pay attention to. So there's not that's a lot of love there, but there's a lot of extra stuff kind of going on under the sheets.
A lot of layers of abstraction there on those contracts, particularly for maybe a typical retail guy to look at that. And you're right, breaking it down the price increments, then backing that into a yield, into a price. It's not quite as straightforward for a lot of people. Not that we don't love, we talk rates. We could, every week someone writes in with, why don't you talk about this product? Could be lean hogs, could be milk, I don't care what it is. So I guess people are never happy, which is a good thing, right, Nick? Because that means they're listening and they're tuning in. They want to know. They want to know their fluid milk or their lean hogs or whatever their product of choice. These days, crypto a lot too. We'll get to that in a second.
Yeah, I mean the rates we probably should spend more time on the Treasury 10-year in particular, because that skew actually moves around a little bit, right? And then honestly, if I had a penchant for it, the live cattle actually gets lots of play in terms of the underlying, but it's just one of those markets that I don't really get the fundamentals of it so much.
Yeah, that's an impenetrable one. Sean, in your many tours of duty on the floor, did you ever spend any time in any like the live cattle or any of that kind of stuff?
I've watched it from afar, but never ventured into the corral.
Yeah, you had to be like 100 and come from like one of traded in the pit, something like that.
That's the one. I knew a lot of guys on the SIBO who, when they left the SIBO to try other products, some of them went into those products, the different livestock and the lean hogs, and what I heard back from all of them was that they could not make heads or tails of anything that was going on. These were experienced index and equity options guys, and they thought, oh, an option is an option. I'll just go into this. And different beast entirely, different rules of engagement, the whole 9 yards. But you're right, there's a lot of, well, we like mixing it up here. We have our surprise products every now and then. Maybe we'll mix in a little lean hogs, all sorts of fun stuff. Speaking of mixing things in, I don't know if you know this, Sean, but TWIFO, for some reason, has been designated by our audience as kind of like the de facto crypto show on our network. So people hit us up with all their questions about the Bitcoin and all the other Ethereum and everything else under the sun. So we'll wrap up with a couple. We just filtered out a couple. There's many, but we'll get a couple here of the crypto questions. You can feel free to weigh in, Sean, as well. It's always fun to talk a little crypto to wrap up the week here on the network. We got a question here from Lincoln G saying, are you guys buying what Dimon, that's Jamie Dimon, of course, obviously, was selling about Bitcoin? He crushed it last week, saying crushed it off about 25 or 30% off his comments that effectively it was all for money launderers and it was a scam. And we also have someone else on the other side here, Tank, saying crypto is up 20 times versus other asset classes. Bitcoin for the win. He links to this article here that breaks down Bitcoin for, I think, I'm not sure what the time frame is here. This is maybe for the last quarter. Yeah, second quarter. He says Bitcoin and other digital currencies outperformed traditional assets by 20 times in the second quarter, according to, again, a report by CoinDesk, so they have some dog in that fight. But still, they said Bitcoin returned 150.6% year over year. Returns for all digital assets, 445%. Global equities in the same time frame returned 15%. U.S. equities, 9.2%. Gold, 7.75%. And real estate, a comparatively anemic 3.2%. So this gets to the fun parts of the question and answer, Sean. Maybe we'll give you pride of place because you're our guest. I don't know. You guys, you give any thought to the exploding universe out there of cryptos? And also, are you in the camp of Mr. Dimon and others who are saying maybe this stuff's a little overblown, maybe a bit of a bubble, or of our friend here, Mr. Tatank, I guess he says that, who's lauding their performance and wants to see more?
I'm watching with eager anticipation. I really don't have an opinion either way, but several people are obviously taking a very opinionated stand.
One or two,
either for or against, and I'm still outside that, not making a decision. But I am definitely watching at this space.
I think the question we all really want to know is when is the FTSE Russell Bitcoin product coming out there? Announce it here for us right now.
I can't go there at this point.
I don't want. It's just us. There's no one else is listening, Sean. You could just us.
Is that why they call this the hot seat?
Yes, that's exactly why they call it the hot seat. We make you squirm a little bit, Mr. Nick. Same question for you. What do you? Which I kind of know how you're from previous shows how you fall on the crypto, but what do you think of what Lincoln G? Are you buying what Jamie Dimon was selling, or are you super hyped for this? 20x performance, and you think this is just the tip of the. You're actually, as I speak, I think you're the only crypto holder in the group here, right here. So you're talking up your book here.
Got a little bit of crypto, a little bit. Long, wrote it higher and then wrote it back down because I didn't see any reason to sell it. I'm afraid. So I have a couple opinions, and you from past shows you heard me like I just didn't get the whole Bitcoin thing, right? It just. But now since there's more demand from people that I talk to on a regular basis, so we're paying a little bit more attention to it. So you'll be seeing some crypto stuff within QuickStrike. But as far as the 20x versus 1x versus 2, it's an unregulated market more or less. So until it's regulated, you can't really compare apples to apples. So it's basically like me going to a chicken fight somewhere and trying to bid something up on something because nobody's there to stop me from doing anything illegal or wet. So that I don't think it's an apples to apples comparison. As far as what Dimon said, he got in trouble because they facilitate crypto trading or conversions through Chase. So people are accusing him of being, trying to push the market down so he can somehow benefit from it internally. So there's some fraud allegations going on with that as well. Yeah. So from that standpoint, and then I think what I've learned, and I've been trying to get educated on this, like we talked about, we were trying. There's so many coins, or that people aren't even calling coins anymore. They're calling them digital assets or cryptocurrencies or whatever, because they don't necessarily translate into a fiat currency, but they could transfer into like a service or something like that. So, but you're going to end up seeing, of the thousands that exist, it'll go down to a certain amount, just like anything else, right? All the tree will get shaken, and only the strong will survive from it. But I think it's going to get good. There is a CFTC CFTC approved index that's on the Terra exchange. So that's one thing that's out there. That's the only CFTC approved one. So that one might see some legs, right? And that gets so that's an interesting thing. But you can't compare it to other stuff because, like anything else, the new is, remember those rubber bands that the kids bought that were in shapes and you couldn't buy them.
Oh, right.
Remember, that's crazy.
Yeah.
So there's always, and this I would put it not in that category necessarily, but until it's on something that people consider a real exchange, right? I don't think, and people are paying attention. You have actually people banding it and making markets, and people looking at what the real volatility. We're going to start doing some vol numbers on this stuff as well. So it'll be interesting to see what all that stuff says.
All right, there's the music. That means, unfortunately, we've come to the end of another epic journey through the world of futures, options. Hit us up. Keep those questions coming. We read them all. If we don't get a chance to answer them all here on the show, and maybe we'll do some sort of listener question palooza down the road. But before we go back around the horn here in the studio one last time. Let's see what each of our guests has cooking up that may interest you. We'll start with you, Sean, our literal guest, the man who's squirming. You can't see him right now, listeners. He's squirming in the CME hot seat. It is indeed. It's warm in here, so it is hot. I can't really blame him. But Sean, like we said, we talked a lot about FTSE Russell. The roll obviously went well, exceeded your expectations. What else is coming from FTSE Russell in the coming weeks and months? What should we expect to see? Give us a little hint, a little tease of what you guys are cooking up over there for us.
I would continue to keep your eye on that RVX product. I think it's an interesting play in terms of volatility. Look for open interest and volumes to continue to grow on the Russell products at CME Group. Really excited about the broad reach of clientele that are trading the product.
I'm glad to hear you bring up RVX because that was always a fun one we liked, from back of the early days of it. And I'm happy to hear. Obviously, a lot of the focus has been, rightfully so, on the big Russell contract and completing the roll and everything. But now that that's done, is it fair to say you guys are going to be taking another look at RVX and maybe getting that out there a little bit?
Absolutely, we definitely think that product has legs and hope it takes off.
All right, I like it. I think next time you're coming on, Sean, we're going to talk RVX. There we go. We just laid it out right now. I like that product. It's a fun one. It needs a little bit of love, so I think we can do that here on TWIFO. Speaking of love, Mr. Nick, we love Quick Strike. So what are you guys cooking up for us? Aside from all the things we already laid out here on the show that you have to work on, but what are you guys cooking up for us here in Quick Strike these days?
Let's see. So, you'll be seeing some crypto stuff coming up here pretty soon, probably next quarter. And if you're a subscriber, you saw Quick Skew is now out there in the regular Quick Skew subscriptions. But what you're going to see probably in the next 30 days is there will be a free version of our tool called Quick Vol, which will give you a shorter dated look at historicals, but it's going to expose you to everything that we have, and then you can make your decision whether you want to step up to the plate and go to the more full, complete version where you can get downloads or purchase downloads. You'll be able to do all that stuff in any level, but, more advanced quick vol tools. We're going to, there's a docket of open interest stuff that's coming out, so just keep an eye on it and look for the new stuff that's out there for free. I always tell you to start with Essentials, the free stuff, because there's some good stuff coming through there, and then take a look at the integrated stuff, and also keep an eye on the CME Direct embedded tools.
There you go. Check out what Nick and his team are cooking up over there. And you can do it yourself. CMEgroup.com/TWIFO. That is indeed the easiest place to get a hold of all of that good stuff. Kick the tires and light the fires, as they like to say. And on behalf of Mr. Nick and Sean and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. Of course, for sending in such great questions. We love you guys who join us live. We love you guys too. And we'll see you next Friday for some more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered. With market data reports ranging from open interest to the term structure of volatility, Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.